The views and opinions of this program are those of the host, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Today's episode of Market Talk is brought to you by Growmark FS. Keeping up with the latest in ag is a challenge, to say the least, but there are experts nearby ready to help. You'll find them at your local FS. You can trust them to bring you customized agronomic, grain, and energy solutions born of the latest thinking. That's because FS specialists receive continuous training that keeps them current on the latest trends, practices, and technologies. So you'll get local expertise that's both exceptional and up to date. Visit fssystem.com to learn how FS is bringing you what's next. All right, now let's dive in and take a look at the July World Agricultural Supply and Demand Estimates, a report that brought more surprises to the trade. A much higher than expected soybean stocks number, higher wheat production, a lower corn yield, but still a record corn crop on tap. A lot to dissect here. And joining us now to talk about it is our good friend Mike Zuzolo with Global Commodity Analytics. And Mike, it's been a while since you and I have talked on a WASD day, so happy WASD Wednesday to you. And I got to admit, I've been excited all day to sit down and talk with you about this report before and especially after we got some of those numbers from USDA, Mike.
We're keeping our streak, Jesse, making the markets go red when you and I get together. So if anybody's, keeping track, past performance is not indicative of future results, but we probably have about an 85% ratio at this point. As far as when we talk, it's usually down in the grain. So nice to be with you too.
Yeah, not a good ratio, but we're still going to talk anyway. I mentioned a couple of notes there at the top, and I just want to walk through the numbers that we got from the WASD. And again, to me, soybean stocks much higher than trade guess. That stood out to me. I know we got a yield drop in corn, demand drop on the soybean side. A lot to unpack here. Just your takeaway. I'll pull up the U.S. ending stocks numbers on our video feed as well. What's your takeaway from the report on Wednesday, Mike?
Well, first glance at that table is the neutral and neutrality of the corn number. And I think that we could have had a higher market reaction after that yield reduction and the fact that USDA actually pumped in 5 million extra bushels into total usage. And that came in then as a result right at market estimates. I think the problem with this market reaction and the corn going down was primarily very, very good rains, especially in the driest and some of the most fertile areas of the upper Midwest and Great Lakes were occurring during the day. And so I kind of slanted this report in my mind as to it better be a good one to be able to offset these rains. And we had a really good outside market in that the US dollar, after the CPI data came out, went in and just pummeled the longs, and we made new 2023 lows in that dollar index several times going during the day. But even with that, Jesse, I think we really needed some good numbers in this report, US numbers especially, because the market was laser focused on the US supply demand numbers, and we didn't get them. We didn't get them in the beans, and we didn't get them in the wheat.
Well, and I want to pull up the world numbers too, just real quick to frame our full discussion here. World numbers, not many changes really on that balance sheet overall. So it seemed like a lot of the fireworks for the ending stocks came on the U.S. side, Mike.
You're right. And I will point out one thing, and this goes back to our typical conversation about the grains, especially the corn, especially when we've got new 2023 lows in the dollar, and that may be igniting the crude oil and the copper, and therefore maybe the wheat, is that 266.5 ending stocks number. Notice how it was on the very bottom of the lowest trade guess estimates and well below the middle part of the range. The USDA took demand up 3.3 million tons, Jesse, and they took production globally down 3.5 million tons, so that we had a net supply loss of 6.8 million tons. That's one of the bigger ones that I've seen, and it's very rare that we see a demand increase and a production decrease in the same month, especially for something like the wheat. So that puts me in the frame of mind, and staying in the frame of mind with the idea that we're still more like 2008. We still need the wheat to lead us higher, especially in the corn market. The most important thing about that global number is 266.5 against a stronger demand number versus last month puts us at a 33.3 stocks to use ratio. That compares to 34% last month, a big cut in supply. So if we're going to look for the lows in this market, I think we look in the wheat, especially given the harvest that we're going into.
Well, and thinking about that harvest too, I want to talk about that just a little bit. Let's look at that winter wheat harvest progress. And we know things have been a little bit slow in parts of the southern and central plains, some of those areas that have gotten rain. So you think about just some of the slowness there. And then also on the world side with everything going on with wheat here, let's expand a little more for us in this wheat trade, Mike. What's your thoughts here after seeing these new numbers from WASDE on Wednesday?
Yeah, USDA gave us a yield increase, went over 46 bushels nationally, and that puts us up where we were about a year ago. I am skeptical of that. I'm not surprised because the soft red wheat harvest has been going very, very fast. Yields are very good. USDA increased Illinois yields today. So I shouldn't have been surprised by the yield increase if you don't count what's going on in hard red wheat. What I was surprised about by USDA was you notice on this chart how slow we are. We're literally at about a 6 or 7 year low in terms of percent harvested. And yet USDA today, with only 59% of the state harvested of Kansas, took the yield up 10.3% versus last month. We were 93% done last year at this time. So I think that wheat yield could go back down once we get more data, because I'm hearing more up and down yields in hard red wheat belt areas. And I'm sure that this rain is not helping things right now.
Well, let's talk a little bit more here on corn and soybeans as well after the report. And one thing I wanted to bring up to you is that the drop in corn, it felt like maybe that soybeans to some degree were helping to prop up corn here on the board a little bit in recent weeks. And obviously with beans dropping a lot, that helped to drop corn too. That's just one thought that was in my head, but it feels like that this spread between corn and beans has just been blown up here after the WASDE on Wednesday, Mike.
Yeah, and that's the interesting part about this market is we did see the new crop beans still gain on the new crop corn in the aftermath of USDA taking corn demand domestically up 5 million bushels, taking bean demand down 135 million bushels. So I was very amazed, I guess is the best word to say, is that the corn could not hold on to at least the ratio and find some unwinding of the bean corn ratio. I still think that's likely, Jesse, especially given that I think today's corn trade was about the weather, was about the yield being supported by the rains that were hitting some key areas. Beans didn't feel that pressure. So if I had to look at the big picture and the long game here, I still think the beans have more to lose than the corn at this point. And that's why I did these historical charts for the viewers. And this is kind of the top end analysis that I do for subscribers and clients. You don't get this from everybody, I don't think. And so December 23 corn is in purple in the middle of your screen, trading very closely with 2013 as far as net price. But look at the similarities in price action to 2008 and even 2009. So you can't quite call it a 2013 corn crop unless you're talking about just flat price. But you notice we can go down lower. We did in 13. We obviously did in 2008. And we did in 2009. And what I wrote clients today was after the report, and now that I've looked at the numbers a little bit more detailed, I think that we could get a low in the wheat coming this month. That actually puts a low in the corn and gives us a chance to go up higher. So I'm not so sure that we won't look more like a 2009 type price action by the end of the month. But clearly the D's corn has more room to go down, to your point, in part because the USDA's opened the door for the November beans to go down as well.
Well, let's talk the November historical chart that you put together as well. And any similarities, differences, disparities that you're seeing on this chart, Mike?
Yeah, here it's a little bit harder. You can see the beans just don't work very well with anything except maybe 2008 in terms of what type of highs they've made, like in the month of June, and then another high made in the month of July. If that 2008 pattern is accurate or close to being accurate, 2008, the beans went from a 1637 high down to an 1168 low. The interesting thing, in 2013, our low was also 1160. So I think the November beans could gravitate towards 1160 if we don't see something change in the dynamic of this market very, very soon, because we just simply need a wheat low in place to support the corn, and then the corn can maybe support the beans. But I'm kind of back on the hunt, Jesse, of really taking care of business on making sure you got a good floor underneath you, rolling up puts on soybeans. Depending on where we close this week, we really need to hold that 13 and a quarter handle in the November beans. And then we've got a really key support line, 52-week moving average in the lead month beans, sitting down there about 50 cents lower.
We are joined today by Mike Zuzolo of Global Commodity Analytics for our market analysis here. Mike, you mentioned the dollar, and I want to talk about that a little bit. I know that CPI data out Wednesday morning ahead of the WASDE report, the Consumer Price Index, and you mentioned making lows in the dollar here. Walk us through some of that data and how that all contributed to kind of the bearish day on Wednesday.
Yeah, I mean, this is important because, the trade is not expecting the Federal Reserve to change course. But all of a sudden today, after the CPI data came out and a couple comments from some Fed governors, like the Boston governor, and I think the Chicago governor, Goolsbee, came out, and they both talked about maybe not needing to raise rates as aggressively. But the chairman of the Federal Reserve continues to say we need to raise rates at least 2 more times. And the trade has made a decided decision now after the Consumer Price Index came in at some of the weakest in terms of 4.8% annually. That was the June number that we just got today. The market expected 5%. That doesn't seem like a big difference, but it was the smallest annual increase in over 2 years. That seemed to just trigger the markets, both the bond market and the currency markets, to say the Fed's done raising rates, even though their policy meeting is still on the 25th, 26th of this month. So I'm really nervous. I'm happy the dollar's breaking, but I'm very nervous the trade's trying to get ahead of the Federal Reserve, and they're going to be getting ahead of a freight train, essentially.
Well, and I have to think that the dollar and the CPI data and just the tone of the stock market probably didn't help out livestock on the day either Wednesday. You would think with corn breaking lower, wheat, et cetera, we'd see maybe a rally in cattle and hogs. We didn't get that either on Wednesday. I'll pull up the cattle chart you sent over for me here. What's your thoughts after Wednesday's action in the cattle market, Mike?
I really think we're similar to 2014 and 2015 in that the market is pricing in an immense premium compared to, and I'm talking about the deferred futures especially, that the front end market clearly has got the cash above the futures price. August futures running $5 below cash prices from what we can tell at this point. But the deferred markets, when you look at where we are in D's fat cattle, we're trading 183 plus, and we're dealing with a market that's about $15 higher than our 2014 high, and even more than that than our 2015 high. What I wanted to show the viewers today on this is December futures only. And so when you talk about beef production, USDA gave us a beef number for 2024 calendar year of 24.77 billion pounds. That's their projected number. Well, back in 2015, we tightened the number up to 23.85 billion pounds. So we're going to go into 2024 with more pounds of beef than we had in 2015, yet we're $15 to $20 above the market price back then, currently in those deferred futures. And this is why I've been pounding the drum so much to let the market rally, but kind of like soybeans, keep your hedges scooted up against you, up against the market in terms of the puts. And I'll throw one more thing at you, Jesse, when it comes to the beef. Actually, 2 more things. USDA did make some big changes today. They took commercial production in beef this year up 75 million pounds and took exports down 10 million pounds. that was in contrast to what they did in pork. They took exports in pork up 110 million pounds today versus last month. That's a big jump, and gives the market maybe some support above $90 now. I still think hogs are running pretty hard, but we got a decent meat market in terms of the pig price, the belly price, and now the USDA numbers. Last thing I'll throw out at you when it comes to the cattle is the beef index, the retail index that USDA keeps track of for what people are consuming, the activity index, the essentially all the featuring that's done all across the stores in the United States. It dropped another 11 points or 11 percentage points again last week. We are losing demand and consumption. So I'm just going to keep pounding that drum unless I find myself to be wrong. As the supply goes down, the demand is also now going down as well. USDA supported that with what they did in their numbers. So just be on guard in those back-end cattle prices, just like we are on the back-end bean prices.
And I'm glad you brought that up. I didn't look too deep at the beef and pork numbers, but to your point on the hog side, I've been looking for some sort of reason to justify $100 front month hogs. And to your point, maybe that change from USDA is it. Maybe this is something that will help us kind of hold steady here in front month hogs, Mike, because I've been looking for a reason lately.
Yeah, the other reason that I think is really useful and could give us kind of a false floor is that we've seen that pork and bean trade really get active again. The hogs and the beans have been rallying sharply together, and that really troubles me when you don't have the fundamentals under you, as you say.
Mike, before we wrap it up and let you go here today, I know a lot of data. There's going to be a lot of fallout here the next couple of days before we wrap up the week. Any final thoughts? Anything on your mind? What would you say to folks listening in here today?
Yeah, the biggest thing I've heard today and this week is I'm getting rain, and is it too late to sell? I mean, that's typical. So I think we need to realize we go through this about every weather market where we don't want to sell because we don't have the yields. But by the time we get the yields and the rains come, the market's already factored that aspect in. So now I divert back to the wheat market. I need a hard low as we close out the harvest books in the Northern Hemisphere, watching the Black Sea grain deal, but looking for that leadership in the wheat, especially the European market still, even after all this news and what USDA did. And I think today's numbers once again reiterate we have plenty of soybeans in this world right now, and we don't want to get too comfortable with these elevated prices.
Mike, if folks want to reach out, talk with you for some market advice, take a look at your analysis, I know they could do that very easily. What's the best way?
Best way is to go to globalcomresearch.com. It's globalcom with 2 M's, research.com, and pick up a free 2-week trial. I'll contact you once at the end of the trial to see if you like anything, get a subscription, or if you want to become a client. Also have a product services brochure on that website as well.
Mike, always appreciate the time. I know today extra busy with a WASD report. Thanks for joining us, and we will talk to you again real soon.
Great to be with you, Jesse. Thanks for having me.
Mike Zuzolo with Global Commodity Analytics. That's going to do it for Market Talk today. Find us online, markettalkag.com. I'm Jesse Allen. Have a great afternoon.